Hello and you're very welcome to this video in our series on Unit 4 for Leaving Certificate Business. And in this video we're going to look at the limitations of using ratios to assess a business. So in the last number of videos in the series we've looked at the different ratios that we use to look at a business performance and how they're getting on. Now we're going to talk about the limitations as to why it may or may not be the best way to look at it. So have a think of what you think the limitations of using final accounts are to analyse a business or ratios, and when you're ready press play to continue. So, one of the things is human relations, okay? The ratios and figures involved in that tell us nothing about how the human relations or the industrial relations are within a business, okay? It doesn't tell us how the staff, the employee get on with management, how employees and employers get on. That's not taken into account at all. So it can be difficult to really assess the climate in a business and the extra value that you get from having good industrial relations within a firm and how that can really help them. Another issue as well is that it doesn't tell you the value of the assets, okay? Assets may not be shown at their actual full value because each year businesses don't get their assets valued every year. Remember, assets is something you own. So, for example, we're talking about their properties, their machinery, their vehicles. They don't get valued every year. So it's up to the firm to individually decide, okay, well, this is how much it was worth last year. We're going to depreciate or devalue it by a certain amount each year, which may not actually give a realistic value as to how much it's actually worth on the market, and this can affect our figures as well. Historical figures is another reason as well. So ratios use figures based on past performance of the business, and it doesn't look at future projections, okay? So it doesn't show us any of the future plans of the business, with the business plans to expand or any future challenges the business may have. It just looks at where it was at right now and where it was in the past. So we have no idea it doesn't have to say anything about the future of the business, okay? Another issue is, we call it balance sheet changes there, okay? But what we're really looking at there is the fact that every day the balance sheet changes. So if you think about your current assets and current liabilities, what you own temporarily and what you owe temporarily. So for example, your bank account balance changes all the time. How much you owe to different people changes all the time. So that means that your ratios are really only relevant and valid for today. Whilst your final accounts, your statement of financial position, that's your trading profit and loss account, they're valid for the period of time which they're written, for example, which in this case usually is the trading year. The balance sheet is an ongoing and it's a live document that's always changing. So that means your ratios can become quite inaccurate very quickly and only give a snapshot at that period of time, which can be misleading. The other thing to think about is external factors as well, okay? Ratios don't even look at the wider business environment, so you've no idea what other factors are at play. For example, there could be new competition in the market which is going to affect the business, or even look at the times we're in there now, okay? With COVID. COVID is a massive external factor which is going to have a massive effect on the business as well, and your ratio figures aren't going to show us that. Another thing is inflation and deflation. This can make it very difficult to compare figures from one year to the next. For example, if inflation is quite high, it can be fairly unrealistic to do a comparison of one year's figures versus another year's figures, taking that into account. So therefore you need to adjust your ratios in order to take inflation or deflation into account. Okay. Another thing to look at is different accounting policies. Okay. Firms from time to time will change their accounting policies and procedures. Okay, from one year to the next. That makes it, once you change your accounting procedures or how you go about creating your accounts, it's very hard, if not impossible, to actually compare one year's figures with another year's figures. So therefore trying to create ratios from one year to the next can make it fairly inaccurate and hard to judge. An example of that a few years back, if you look in 2015, is when Google decided to change its accounting procedures and restructured how the company was set up from an accounting perspective. It then started to trade as a company called Alphabet Inc. So you can't actually buy shares in a company called Google anymore. You buy shares in a company called Alphabet Inc., which is Google. Okay, so therefore it wasn't able to compare its 2016 accounts to 2015 accounts with investors because of the change in accounting practices they went through. So, in this video we've looked at now the limitations of using ratios to assess a business, and hopefully you have a better idea as to why ratios can be useful and what's of value. There's also certain limitations and things that the ratios don't tell us about the business. If you have any questions, ask below in the comments, and if you enjoyed the video, why not give it a like, and of course please subscribe to the channel by clicking the button over there. Thanks very much for watching, and see you in the next video. Bye now.